Looking to sell your house and don't want to pay taxes? Well, let's break down the IRS rules on a tax-free sale and debunk some myths. The IRS has limits on how much gain you can have on the sale of your house that qualifies to be tax-free. For an individual, that is $250,000, and for somebody who is married filing jointly, that is $500,000. Now, real quick, how to calculate your gain is to take your sales price minus whatever you purchased your home for and minus any additional money that you put in for extensive renovations. You can actually add that to the basis of your home, so that would reduce your gain as well. So sales price minus your purchase price and minus any significant improvements that you made on the home. Now, if you're wondering what qualifies as a significant improvement, make sure you read the IRS rules or consult with a CPA. Now, if you are an individual who owns a house with another person and you are not married to them, both of you will have up to $250,000 worth of gain that you can have be completely tax-free. So if you love to save money on taxes, do me a favor and hit that like button. It helps me be able to help you. Now, to be eligible for these gain limits, this $250,000 as an individual and $500,000 as a married couple, you have to meet certain criteria on the sale of your home. First, your home has to be eligible. One of the major rules is you cannot have acquired the home using a 1031 exchange. 1031 exchange is a different tax strategy where you sell a property and immediately go and buy another property so that you can avoid, or not avoid, more like postpone your capital gains tax on that. A lot of people use this for business assets. Rule number 2 is ownership. You had to have owned the home for 2 of the last 5 years. Now, if you have not owned your home for 2 of the last 5 years, stay on this video because there is a loophole that I'm actually going to explain a little bit later that you can get around this rule a little bit. Rule number 3 is the residence rule. This means that you've had to have lived in the home for 2 of the last 5 years. This one really comes in when you've lived in a home and then you move away and you rent it out. So if you own a home for the last 6 years and say you lived in it for the first 2 years and then you've rented it out for the last 4, you would not meet the residency rule because you've only lived in it for 1 out of the last 5 years. You have to have lived in it for 2 of the last 5 years. One of the final rules is the look back rule. This is rule number 4. You can't have used this same exemption within the last 2 years. All right, if you are finding value in this video so far, please do me a favor and hit that subscribe button. All right, let's debunk some of the big myths. One of the biggest myths that I've seen is people always ask me like, okay, if I sell a house, do I have to take that money and buy another house with it to be tax-free? The answer is no. In this situation, if you're using these rules to get out of a tax on selling a home, you do not have to take the money and reinvest it in another home. You just have to meet the rules that I just explained. People get this rule mixed up with the rule surrounding a 1031 exchange. Like I said before, that is a like-kind exchange that is used for business assets. That one, you do have to reinvest the funds. But under this rule, claiming $250,000 or $500,000 exemption on capital gains when selling a home, you do not have to reinvest it. The IRS does not care what you do with that money. This often leads to a follow-up question like, okay, well, what if I do and take that money and go buy another house? Does that mean that I get special treatment on it? And the answer is no. If you don't meet the rules that I just explained, regardless of what you do with that money, the IRS is not going to let you have that sale tax-free. Let's jump into the loopholes that I alluded to earlier. These loopholes allow you to exclude gain from the sale of your home. It will just reduce the limit that I explained earlier. So right now, the limit is $250,000 for an individual. Now, a lot of those rules are based upon how long you owned and how long you lived in the home, and they are based off of 2 of the last 5 years. Now, if you've only lived in the home for 1 year or owned the home for 1 year, that is 50%, right? You've lived in it for 1 year when the rule says you need to have lived in it for 2 years. Thus, you've lived in it 50% of the time. So you'll take that gain, the $250,000 limit, multiply it by 50%, and take that limit down to $125,000. So if you sell the home for a gain, if it is below $125,000, then the entire gain would be tax-free. Now, if it were above $125,000, $125,000 of that gain would be tax-free, and anything above that would be taxed. And this works with any amount of time that you've lived into it, up to 24 months, right? So if it was 18 out of 24 months, that is 75%. So you would take the $250,000, multiply it by 75%, and that would be your new limit. You can use this exact same math if you are married filing jointly. You would just take $500,000 instead of the $250,000 that I used in my example. All right, let's jump into the loopholes. So loophole number one is if you've served in the military while owning the home. A lot of times military personnel will be sent off and they'll be living elsewhere because they're deployed. Now, if this is the reason that you end up selling the house, then you can apply this loophole and still be able to get an exclusion on your gain. Like I said, the limit will just be decreased depending on how long you owned and lived in the home. Loophole number two is if you moved for work. So if you had to move greater than 50 miles away for a new job, or if your current job transferred you, then you can apply these rules and still sell your house with the exclusion of capital gains. Another one is if you move for health-related reasons. Now, this can be to get better health care. This can be to take care of a family member. Family members is pretty extensive in the IRS rules. So this can be you, your spouse, son, daughter, aunt, uncle, grandma, grandpa, parent. So if you have to move for health-related reasons so that someone can get the care that they need, then you can apply these rules. All right, now this one's a little more broad. This one is an unforeseeable event. So if you move because you got a divorce, or you had twins, or you were separated, something like that, then you'll be able to apply this rule and be able to sell your home with the new limit in place and hopefully exclude a huge chunk of your capital gain. More items that can be included is death of a spouse, becoming eligible for unemployment, change in employment. Those are all unforeseeable events that you can use to get this loophole. Now, the final loophole is one that the IRS is actually leaving up to interpretation. So this one is other facts and circumstances. Now, there are some rules behind it that you need to make sure that you follow. And if you're going to claim this as the reason that you qualify for these loopholes and can exclude gain, you're going to want to make sure that you have these taken care of. You're going to want documentation that the situation that is requiring you to sell the house arose while you were in your home. You can't claim that you had to sell a house because you had a parent die 3 years ago when you just bought the house last year. That would not work. You would have to have a reason that it came about when you were living in the home. Number two is that you sold the house quickly after whatever situation it was arose. You can't have the thing happen, wait 5 years, and then sell your home. Number three is you couldn't have anticipated this thing happening. It can't be something that was reasonable. It had to have been something that was unforeseen. Another thing is that your house has to have become significantly less suitable for your family. One example of this, and there can be many examples, this is where the IRS is actually leaving it up for you to interpret. But one example that I've thought of is if you and your spouse got in a car crash, and heaven forbid, one of you ended up paralyzed and you needed to have handicap accessible, right? And so you sold your home, moved somewhere that it was easier to manage with, the new disability that you would have. Something like that. That would be unforeseeable. It happened while you were living in the home. You sold the house quickly and you went and found a house that was much more suitable for your needs. If you have any of these things, any of the things that I just mentioned, you qualify for the IRS loophole. You can claim exemption to your gain. Just remember that the limit to that gain will be decreased depending on how long you were in the home. So I actually had this happen to me. I moved quite far to go to a new job, and I'd only lived in the home for 23 months, so that's 1 month short of having a tax-free sale. So I actually applied these rules. I will leave a link in the description on a video that goes through all of my math on it, so if you have any questions, you can go check out that video. These loopholes are great, so consult with a CPA. If you feel like you qualify for these loopholes, go take advantage of them and sell your house tax-free. As always, if you have any questions, please hit me up in the comment section and I'm happy to help.